want to bring in Marvin Lowe. He's a senior global macro strategist at State Street. We also have Gregory Daco, a chief economist over at EY. Guys, Greg, I'll go to you first, just in terms of how you think this plays into the Fed factor next week. When you take a look at this print, clearly we did see a bit of an acceleration when you compare that month-over-month reading to what we saw last week, but very much in line with these expectations.
Well, I think there's a bit of good news and a little bit of bad news. The good news is that we have an environment in which we're not seeing any acceleration in inflation. If you look at the core print, 0.3% in line with expectations, in line with the last few months. Yes, it is a little bit hotter than the Fed would desire, but you're seeing that inflation on a year-over-year basis is still moving closer to the 2% target. So that is encouraging. The bad news is that there is indeed some stickiness in the underlying inflation dynamics. You're seeing core goods prices rising. This is something that we have to be a little bit careful of, especially as we look out on the horizon with the potential for tariffs that could be inflationary. Overall, though, shelter cost inflating a little bit less than expected. That's an encouraging sign as we're seeing housing price inflation start to moderate and help with the inflation dynamics overall.
Marvin, I mean, just easily, as you're thinking about the first trade that you would be thinking about, or if this just further settles you into your existing positioning coming off of a print like this, what comes to mind?
Yeah, I mean, I think the fact that it's consensus means the market's going to get comfortable with it. So we'll firm up what's already a pretty firm expectation for the Fed next week. Market was pricing over 80% that they're going to cut. Everything that we've heard up until now is that, they're looking at the disinflationary trends, not necessarily the numbers. I do look at the numbers, however. Spot 3 month over month is nowhere near what they need to see in order to get to 2%. We're seeing a lot of the stickiness that you talked about. And, for sure, the market is really questioning whether or not the Fed can get to that 2% number. Market pricing at this point is that we're pretty much done with this cutting cycle after the next 4 cuts. That's much more aggressive, at least on the upside from a yield perspective, than what the Fed had said just 3 months ago. Every 3 months, it seems they change their mind, so we'll see how they change their mind after the September to December kind of time period. But yeah, I mean, the sticky conversation is making its way into the numbers, and risk is performing well, but there's a lot of risk associated with that.
So it sounds like this is almost green light here for the Fed to cut by 25 next week.
Well, perhaps green light, but I would be very careful with market pricing right now. Markets are very certain that the Fed is going to proceed with a 25 basis point rate cut next week. I think the odds are closer to a coin toss, honestly, because we have an environment in which Powell usually goes into these meetings with a little bit more agnosticism than the rest of his peers. And you've heard that he's talked about the economy performing better than anticipated, that inflation is somewhat hotter than expected. And yes, disinflationary momentum is still in place, but I think the Fed is going to want to be cautious going forward. So I would still anticipate a rate cut at the next meeting, but there's going to be signaling that the next few rate cuts are going to be longer spaced and that there is going to be a bit of a pause until the next rate cut, especially in light of the expected policy environment. Yes, policy makers do not guess, they don't assume, as Powell said, but they are going to be conscious of the fact that all of the policies that are being proposed by the incoming administration will have an inflationary effect.
What would the market's kind of realization of longer spaced rate cuts look like? I mean, it seemed like if you had asked us or asked any economists 2 weeks ago that it was once a quarter in 2025 that it sounded like.
Yeah.
Now, longer spacing, that might sound like once a half, maybe, once, every trimester. I don't know.
Yeah, I mean, if we start to hear that they're hesitating to that cadence, a 6-month period, there's a lot of data that they can absorb. There's a lot of numbers, obviously, every month. It would indicate to me that there is enough concern with the FOMC that they want to collect that data. I think the market expects the Fed to go to a quarterly cadence. Again, the market really only has another 3 next year once we kind of get through this December cut. If it starts to appear as if they're wavering as to whether or not they can cut, which is kind of the 6-month cadence. It's like, I want to see so much data that I can make a decision. You start wondering if you're even aggressive from that perspective. The good thing from an investor perspective is that we're not looking at rate hikes. Certainly they're going to wait to see how this administration, how policy, how tariffs actually impact inflation, whether it's transfer. There's so many questions left to answer. But if the Fed still thinks that they're restrictive, if they still think that there's a degree of comfort that they can continue going down that normalization route, the market's going to absorb it correctly. Any sign that they question whether or not they're done with this cutting cycle, that's a different regime shift.
Does that signal correction? We had a guest on yesterday that was saying that we could potentially see perhaps 10% pullback sometime in the first half of next year. Is the Fed changing of the tone something that could trigger that?
You know, there's a lot of momentum in kind of this soft landing type of discussion in the market. I think we would have to parse it with a lot of different things. Sure. It's still a soft landing if the Fed isn't hiking, right? If the Fed isn't looking at needing to retighten, it means things are good. You still have to figure out what companies are going to win, which companies might be a little bit off sides, particularly with these tariff discussions. But it still shows an economy that's pretty solid. And to me, that's an important factor in all of this. Valuations are hard. Everything's expensive.
Marvin, is the market though too quick to discount some of the inflationary risk that Greg was talking about going into next year? So then what type of risk then does that pose when we're trying to figure out just in terms of, I guess, how quick of a reaction we could see in the markets? What do investors then need to know?
You know what, so I'm a rates guy. I spend a lot of time thinking about what this one number is 10 years in the future means. Probably the biggest risk in my mind is that whether it's debt sustainability and or inflation volatility, if you will. The view that the current uncertainty around inflation goes away and just is stable in the future, to me, is really a big jump forward in terms of just being comfortable with the market. If we think that inflation is really on an up and down path that we've seen going forward, we're not being paid for that risk within the rates market, if you will, and that number affects every other asset class.
Best projection for what you think the terminal rate could look like from the Fed, given some of the cadencing that you were talking about earlier?
Terminal rate today or the terminal rate whenever they get to the terminal rate? That's a big question because disinflationary momentum is still in place. Fundamentals are still disinflationary. We're still seeing more cautious consumer spending, which is limiting pricing power. We're still seeing wage growth being disinflationary, given how strong productivity is. And we just had the lowest post-pandemic readings in terms of rent and OER. That's also disinflationary. So yes, I think the Fed is going to proceed more carefully as it searches for neutral in an environment where policy uncertainty is likely to be inflationary, but we're likely to settle at a rate that's closer to 3% than it is to 0 as it was before the pandemic.
Thanks for reminding me. I need to go back and renegotiate my lease terms on my rates. Thanks so much, Marvin and Greg, for taking the time here with us this morning. Appreciate it.